Chinese in particular are buying a lot of crude and putting it into storage.
The Chinese are buying not because their economy is booming, it's primarily for stockpiling.
China, a country that spent decades rising in power, is now preparing for something the world doesn't fully grasp. In silence, without grand declarations, Beijing is getting ready for a crisis with potentially global consequences. It started with reports that the state oil giants, Sinopec, CNPC, and CNOOC, are expanding crude storage capacity by 169 million barrels.
This year, China has been consistently buying more crude than it needs to supply its downstream sector, and socking away the additional into storage, sometimes as much as 1 million barrels per day.
But that's only the tip of the iceberg. The goal is to build reserves that would let the country survive a full 6 months without external supplies, roughly 2 billion barrels of oil. For comparison, America's strategic petroleum reserve holds just 404 million barrels, and the United States is simultaneously the world's largest producer. This Chinese project is no accident. It's a direct response to the world reshaped by Russia's invasion of Ukraine. Beijing saw how sanctions can sever economies from critical energy sources. And while China officially maintains neutrality, in practice it's preparing for a scenario in which access to global commodities could be throttled, whether by sanctions, a clash in the South China Sea, or fresh turmoil in the Persian Gulf. Everything suggests Xi Jinping no longer believes in the stability of the global energy market. Hence the billions of dollars pouring into strategic reserves, storage, and transport infrastructure. According to Reuters, in 2025 to 2026 alone, 11 new mega facilities will come online, enough by themselves to cover 2 weeks of imports.
I think even OPEC Plus didn't expect that China's crude imports is still such strong in this year. And then people start to realize, China has built a lot of oil storage during the past years. And then the question would be, how long will this last? Will China continue to build more stocks in the upcoming months or years? And I think the answer is yes, because I think the capacity is still growing.
Yet this frenzy of oil stockpiling is about more than fuel. It's about bracing for economic turbulence already looming on the horizon, and potentially for global threats including conflict. So today we'll examine why China is building vast oil reserves and what that could mean for the world. We'll also look at what is happening inside the Middle Kingdom right now. Let's dive in. China's crisis preparations are no longer just about hoarding resources. They're part of a much broader strategy to ensure against chaos on global markets, a path that could, paradoxically, help unleash that chaos. On September 10th, China imposed drastic export controls on its rare earth metals, the backbone of most modern technologies. It's a major global economic risk that could force the West to scramble for alternatives.
Authorities there are further tightening export rules for crucial rare earth.
The Chinese Ministry of Commerce releasing a couple of announcements this Thursday outlining new rules relating to those 17 chemical elements which are extremely rare to find in their pure form and which are crucial in many high-tech products, from loudspeakers all the way to electric cars or jet engines. Beijing had already put in place restrictions back in April, creating shortages in many sectors around the world. And the new rules basically formalize these rules and add new ones on top. In addition to always requiring government permission to export rare earths and rare earth technologies, overseas exporters using Chinese rare earth tech or products will also need to obtain a license from the Commerce Ministry.
According to Reuters and Kepler analysts, in early September 2025, China's combined crude stocks reached 799 million barrels, up more than 109 million from early 2023. But that's merely phase 1. Beijing aims to reach 2 billion barrels, equivalent to 6 months of imports. For comparison, the United States, the world's largest oil producer, holds about 404 million barrels in its strategic reserve, In 2025 to 2026 alone, Sinopec and CNOOC plan to add 169 million barrels of capacity by expanding 11 sites, from Shandong and Fujian to landlocked Yunnan. Many of these installations are underground salt caverns, resistant to bombardment and hard to spot from the air. That makes oil reserves part of strategic infrastructure, akin to air defense systems or military communications networks. But the stockpiles themselves don't explain everything. China's economy is at a turning point. For the first time in 4 decades, GDP growth has fallen below 4%, and exports, long the primary source of hard currency, shrank by more than 8.5% year over year in the first half of 2025. The young generation entering the labor market is facing record unemployment of 19.6%, and the property sector, which for years generated as much as 30% of GDP, is in a prolonged crisis.
China is looking to show strength on the global stage, but there are new signs of trouble at home. The economy here is still growing, but not the way it used to. And the bigger problem is demographics, today revealing this steep decline in the country's birth rate. The government has been offering incentives to couples to have more kids, things like tax breaks and cash. China's leader Xi Jinping even urging women to fulfill a patriotic duty. This is all a sharp reversal of a policy that for decades punished couples for having more than one child.
According to a UBS report from July 2025, the value of unsold housing exceeds $2.4 trillion, while developers like Evergrande and Country Garden teeter on the brink of collapse. In this context, oil reserves become not only an energy backstop, but also a financial policy. In the event of a sudden market shock or sanctions, China could sell part of its reserves to steady the yuan and dampen inflation spikes. That matters because since early 2025, the currency has lost nearly 6% against the dollar, and foreign investment inflows have fallen to a 30-year low. At the same time, Beijing is playing the global energy market with surgical precision. It buys discounted Russian ESPO crude from Cosmino, sometimes $14 to $16 below Brent, while ramping up imports from Iran, which after 2024 trade arrangements has become one of China's key energy partners. Notably, imports from Venezuela and West Africa are also rising, countries under partial US sanctions, allowing Beijing to diversify risk and build a supply network less dependent on Western finance and insurance.
March to June, China has put 140 million barrels of crude oil into storage, which is a huge number, I think. We think China will continue to build stocks and also into next year.
In the background are preparations for a Taiwan contingency. According to a Defense Intelligence Agency analysis from September 2025, the Ministry of Industry and Information Technology has begun testing emergency procedures to ensure continuous fuel supplies for the military and transport, even if the Strait of Malacca, the route for nearly 80% of China's oil imports, were blocked. That helps explain why some new reserves are being built deep inland, far from likely missile targets. While the West focuses on sanctioning Russia and keeping commodity markets balanced, China is building a wartime economy in peacetime. No declarations, no podiums, just a quiet, methodical march towards self-sufficiency. In that quiet lies one of the defining signals of our time. Beijing is preparing not only for an energy crunch, but for the possibility that globalization, as we know it, could end. There's a common marker across major economic and political upheavals, from the crises of the 1970s and the 2008 financial collapse to the COVID-19 pandemic, sudden surges in gold prices. It's no coincidence, when faith in fiat currencies and paper markets wobbles, investors flee to a metal long seen as chaos resistant. Gold becomes the ice that melts more slowly than the rest of the system.
Most central bankers want to weaken their currencies, and that usually means printing, figuratively or literally. Gold is the only currency that can't be printed. And I can tell you in the mining business, you almost can't really find it in any size any longer. So when you have central bankers trying to debase their currencies and the mining companies can't find it, you have a very interesting currency. And it's the only asset which these central banks have that isn't somebody else's liability. When you own gold, it just is what it is. You own it.
History shows that when uncertainty takes hold, gold moves fast. During the 2008 to 2012 global crisis, Bureau of Labor Statistics data showed the PPI for gold more than doubled. In the 1970s, after the dollar left gold and inflation ran hot, the metal jumped from around $35 an ounce in 1971 to nearly $850 by decade's end. Today, we're seeing another such moment. The price has broken above $4,000 per ounce, more than a 50% gain in 2025, signaling a rush into safe havens amid market storms. China too has been one of the countries aggressively boosting its gold reserves. This isn't just panic, it's shifting expectations. Inflation, money printing, currency devaluation all make gold look like a real anchor of value. And alongside China's plan for half-year oil reserves, it's no surprise markets are on edge. Meanwhile, Russia, long cast as a commodity bulwark, is showing cracks. First sanctions, then limited access to modern extraction and refining tech, and now physical strikes on infrastructure. Reuters reported in September 2025 that Ukrainian drone attacks forced many Russian refineries to cut output, causing shortages of certain fuels at inland terminals and filling stations.
Exports tend to peak in the winter months, like we saw last winter, and as we saw in the winter before that. But if Russia's running behind this year on diesel production because of those stresses on the refinery system, we may see fewer barrels sold into the export market. That's a big question mark for us right now. That means somewhat lower oil sales revenues, but probably not enough to change behaviors in Moscow regarding its war on Ukraine. To reduce revenues enough for that will require tougher sanctions and rigorous enforcement.
Perhaps China, watching how Russia is being squeezed, simply wants to be better prepared. If a Taiwan conflict did erupt, building reserves would be a prudent move, though this need not be war planning so much as hedging against global economic upheaval. It's hard to say exactly what's driving Beijing's decisions right now, but one thing is certain, this is no accident, it's a long-term strategy. Let us know what you think China's aims might be beyond the ones we've outlined here. That's it from me for today. See you in the next one.